Hi guys, welcome back to the channel. My name is Dave, and last week we talked about building a core for your investments, and I compared buying the S&P 500 versus a combination of SCHD and SCHG, and I'll link that video down below. I consider those types of investments to be my core. This is my long-term investment bucket, and I'm happy to add to those types of positions throughout the year. So if I have a few extra dollars this month, maybe I toss it in my core holdings. If there's bad news or the market's just getting beat up, maybe that's a great time to ignore the blabbering idiots out there talking about short-term moves in the market and likely, based upon U.S. history, a great time to add to your core. So I toss it in and I go for a walk. This week, for those out there craving just a little bit more income from their portfolio, I want to build in some income around my core and give you some examples. So what can we add to our portfolio to give us some distributable income? If that is what you're looking for, please stick around. Today I have 5 categories to show some different ways I add income around my core, and I'll give you 2 examples from each category. So let's start with bonds and bond funds. I like to buy bonds directly, but in the bond fund category, we will have lots of options, including government bond funds, corporate bond funds, and tax-free municipal bond funds. So most bond funds pay monthly distributions from these funds, which can be a nice perk for income investors, so they can work well. One I have been buying lately is IGIB, which is a corporate bond fund that currently yields 4.46% and has an expense ratio of just 4 basis points, which is great, or $4 per $10,000 invested. Now, this fund holds nearly 3,000 corporate bond positions in companies like Bank of America, Pfizer, and JP Morgan. You know these well. It'll have some interest rate sensitivity, but less compared to things like LQD, which has about the same yield, but longer duration. Now, if you think interest rates are going up, you might give up some yield and look at something with even shorter duration compared to IGIB. I also am a fan of municipal bonds, and I routinely buy VTEB from Vanguard. This fund yields 3.26% at the moment, and that income is beautiful, tax-free monthly distributions, and the expense ratio is very low at only 0.03%. The fund holds nearly 9,800 municipal bonds from all across the USA. So this fund, like IGIB, will have interest rate sensitivity. So if you want to greatly reduce that factor, check out VTES for shorter duration bonds. You'll give up some yield, but interest rates will have little effect. Next up are covered call funds. These can really boost your distribution. Some have extremely high yields, but I tend to stay away from those that do. We've talked about a bunch of them on this channel. You can check those out, but I'll give you 2 today that I own that I also think have a really good track record and low fees. So the first is GPIX. This fund is from Goldman Sachs. It's based upon the S&P 500. It owns every stock in the S&P 500, and then it sells calls against a portion of the fund out about a month on a weekly basis. It distributes this income once per month, and that income can be tax efficient and often fall in the return of capital bucket. So I talked about that in this video. I'll link it up above and below. But back in 2024, based upon my tax information, 82% of the income I received from this fund was return of capital, and that shielded me from quite a lot of tax last year. Now, the fund currently yields 8.81%. It pays monthly distributions, and the expense ratio is just 29 basis points, which is pretty darn good for these types of funds. Aside from that, the performance has closely mirrored the performance of the S&P 500 for total return. So it really boils down to if you want the income now or you want the growth. If you want the income, this does a pretty good job of stripping it off in a tax efficient way. My second covered call fund is the sister of GPIX, and that's GPIQ. This fund is set up like GPIX, but it's based upon the NASDAQ 100. The expense ratio is the same, but the yield is higher, currently sitting at around 10.94%. You get more yield with more volatility. This one also paid mostly return of capital in 2024, and it did slightly lag the performance of the QQQ over the last year, so you did give up a little bit of performance. And before we jump to category 3, all the charts and information that you see here comes to us from Seeking Alpha. I am a Seeking Alpha affiliate. There are affiliate links down below for discounts, so check those out if you're looking for a stock and ETF research tool. It's kind of my go-to app for this kind of information. So it works really well, especially when we start talking about these covered call funds and things like that. Any kind of alternative product. You're going to find great information right here on Seeking Alpha. So again, check out those links below for a discount. Next category for me are real estate investment trusts, or REITs. Real estate investment trusts are a good way to add yield and get exposure to real estate without the hassle of actually buying physical real estate. So one of the most popular, and one that I have owned for many years, is Realty Income Corporation. The ticker symbol is just a big O, so it's easy to find. They primarily own commercial properties. If you look at a 10-year chart of O, it's going to show you that it's only up about 20%, and it really hasn't gone anywhere. However, it is a dividend aristocrat, and it has consistently paid and raised dividends for over 25 years. It yields 5.66% currently. It pays out every single month. It's been a staple in my portfolio. Another REIT that I own is LTC Properties. They own long-term care facilities and senior housing. And last time I checked, we are an aging population. So this REIT currently yields 6.47%. My strategy with this REIT has always been to sell at the money calls against my holdings way out into the future. That typically turns this 6.47% yield into about 12% for myself. For more on that, check out this video where I go into more details. Overall, it has worked out well for me over the years. Next up are BDCs. These are business development companies. BDCs give investors like you and I access to small and medium-sized companies that are not publicly traded. So now we have access. Also, since they're typically structured as RICs, or regulated investment companies, they must distribute a large portion of their income to shareholders, again, like you and me. So the first in this category is ARCC, also known as Ares Capital. This BDC currently yields 9.23%, and that's paid on a quarterly basis. It has shown some growth over the last 10 years, along with paying pretty consistent distributions year in and year out. I also own Main, M-A-I-N, Main Street Capital, which yields 7.8% at the moment. And this one pays monthly distributions and has shown some price appreciation over the last 10 years compared to ARCC. Interestingly, though, about both of these, both ARCC and Main have outperformed the S&P 500 over the last 10 years for total return. So pretty darn good results from these BDCs. My last category for today are MLPs, or Master Limited Partnerships. These tend to be things like energy infrastructure and distribution systems, so think pipelines. And for those that are in high tax brackets, MLPs can be a good option since distributions tend to be mostly a reduction to your cost basis, and therefore much of the tax burden we get to kick down the road. So I've been buying one, ET, that's Energy Transfer, for several years. ET is all about pipelines, and currently it yields 7.86%, and they distribute on a quarterly basis. It's also about 100% in the last 5 years, so you've seen some nice price appreciation. Now with MLPs, you will get a K1, so you'll need to enter one more document come tax time. It's not a big deal in my opinion, but it's worth mentioning, and not everyone will agree that that's not a pain in the butt. My other MLP right now is EPD, or Enterprise Product Partners, and that MLP currently yields around 7%, and like ET, they transport and process natural gas, crude oil, and other petrochemicals. So it has performed pretty well the last 5 years, and it works well for me come tax time. So again, I'm looking for tax efficient products, and this fits the bill. Now, in case you are wondering, the average current yield across all 10 of the products I mentioned is 7.15%. So if you're like me and you want some cash flow from your investments, check these out as an option to build around your core position. So there you have it, 5 categories, 10 options in all. Which one is your favorite? Let me know down in the comments below which one works best for you. And if you've got something else that you think is even better, please let me know, because I'm always looking to expand my own core. Now, any questions on this, ask down below. We'll see you next time, and have a great night. Boop.